We've got our first in-studio guest with us here in New York. We're watching markets in response to the Fed decision and central bank policy. Joining us now in studio to discuss the many factors weighing on markets right now, we've got the Credit Suisse Securities Chief U.S. Equity Strategist, Head of Quantitative Research, Jonathan Golub. John, great to have you here with us this morning.
Pleasure.
Your reaction from the policy decision that was not just made yesterday, but also what was kind of set forth in terms of the target rate that the Fed is going to be moving towards?
Yeah, the 75 basis point move, even if they did 100, that wouldn't have been the story. It was how far they're going. And Julie, I think you nailed it. I think you said it's the in-between time rate. So basically, what they were forecasting that Fed funds would be 100 basis points higher by year end. So the market was basically forecasting before the meeting, 75 basis points September, 50 at the following meeting, and 25 in December. And all of a sudden, those get ratcheted up to something more like another 75 and another 50. I mean, they really move, and it's a much more bearish tone. But the market was already forecasting that the Fed was going to move up the terminal rate by about 50 bips. So it's not as if, so the Fed basically is kind of fessing up to what the market was already expecting directionally, but in many ways they kind of just turn that amp up to 11 on the issue.
Yeah, it's always fascinating to me when the market is broadly expecting something, but when the Fed admits that and says, yes, you're right, that is what we're expecting, that you still see the kind of reaction that we saw yesterday. So spell it out for us then. What does this mean for markets? What does it mean for recession implications, and how are stocks going to continue to price all that in?
So, we did this study over the summer, and we looked at the last, 50 plus years of recessions, because we use this word recession like we know what it means, but then we actually say, can the consumer keep spending during a recession? How much does the unemployment rate go up? What does it mean? And there was a comment that you were highlighting from before that you've never had a 50 basis point Fed, I'm increasing the unemployment rate without going into recession. In reality, you've also never gotten a 50 basis point increase in the unemployment rate where it only goes up by 70. The average move is 3%, and the lowest you've ever gotten is 150. So the Fed, in their projections on the unemployment rate, is kind of saying we're going to be half pregnant. So either we're going into recession and we're going to have a lot more people lose their job. Listen, you know what a recession is? 4 million Americans on average would lose their jobs if we go into recession. Now, it could be historically as little as 2, as much as 6, but that's a really big deal. The numbers the Fed was putting out there were kind of for the world's most mild recession. So it was, or maybe they're split. Maybe some people are had a view that we're going to avoid a recession. Some people thought we'd have, a normal recession and you get an averaging. But that's the issue. The other issue is this, the question of the inflation itself is way more nuanced than I think people realize. Let me be specific. Expectations right now are that in a year from today, the inflation will be well under 2.5%.
So take us into your equity strategy playbook then, if all of those scenarios play out as you expect them.
Right.
What are the sectors that you would be looking at the closest, perhaps maybe not individual names, but perhaps more broadly sectors that our viewers, traders, they might be looking at to invest in? All right, during that time?
So let me highlight the dynamic that I think was missed a little bit in this conversation. Here's the playbook for recessions, and then here's how you respond to that. About a year before you hit a recession, on average, the weekly jobless claims, number of people who've gotten fired, who are applying for unemployment benefits, those start to go up. Basically, a year before recession, companies start firing people. That's, let's call it the pre-recession. We are in that.
I was going to say, that seems to be happening right now.
No, it's seriously happening. And it started actually in March. So we are now 6 months into that process. But the unemployment rate doesn't rise during that period. Why? There are so many open jobs every business cycle, not just this one, when you're going into recession, that the first thing that somebody fires does is they go across the street, they get a new job, they got fired, but the unemployment rate doesn't move. At some point in time, that fired worker looks for a job and says, shucks, there's no more job openings. We are at a record number of job openings. We have over 11 million. What would be normal? 6.
So it's going to take longer for that unemployment
Way
rate
longer.
to go higher.
So I think that the big surprise here is that the economy is going to stay pre-recessionary. It's going to feel lousy. Companies are firing workers. The ISM is going to go below 50. Everybody's talking about corporate profits, but they don't fall apart. And if you as a consumer can get another job, you keep spending money,
So
and that's going to be the surprise.
So, but that implies that despite what just sounded like skepticism in the Fed's view that we're going to have this uber mild recession, it sounds like that would be something in favor of that view, that the recession
I actually think that
mild.
what you're going to get is you're going to get the ugly recession, but it's going to be later. I think that this, if you look at how many open jobs are, it looks like this is going to take well into 2024 before we have, and if you look at a recession, which is, it's a deterioration in the employment, in employment. That will probably take longer than we think, and therefore the consumer stays in the game. Growth expectations, now you said, how do you play this? Consumer discretionary stocks, the forecast for the earnings over the next 12 to 18 months are great. So, I mean, you wouldn't think that they would be, but they're really strong. And a matter of fact, cyclical companies in general over the next 12 months or 18 months are expected to do pretty well because it looks as if we're going to stay weak, but not recessionary, and that means it's okay to invest.
But even with like inventory correction going on, for example, in retail and other consumer goods, or when you talk about consumer discretionary, is it more on the services side that we're going to see that's
probably more on the services side? But even if you look at the inventory situation. Right now, you have, because of supply chain issues, a mismatch. You're a retailer. You get those sweaters in with the Christmas tree on them, but they show up in February instead of November. You have to sell them at a discount, and it's a disaster. But those things should start to fix themselves. But you are seeing, whether it's at Walmart or Target or even Amazon, that people are buying services. You want to get a hotel room or restaurant reservation, impossible. And you want to go, and on the other hand,
Pricey.
It looks like car prices, when we get cars back on the market, which is beginning already, that they're going to come plummeting down. So there's not one, the consumer's strong. Okay. The different kinds of consumer companies, to your point, Julie, are going to behave a bit different from each other.
Well, I guess to come back to the question that I was asking a moment ago, with regard to an investor's time horizon, if you are looking out the next 3 to 5 years, you were just describing a scenario where the recession doesn't actually hit until 2024, right, perhaps, or at least the deepest implications of it. So for somebody with a 3-year, perhaps, time horizon, it sounds like we're staying defensive for a very long period of time in that instance then.
If you're really a long-term investor, you really have a disincentive to try to time these things all together. Sure. If you have a recession earlier, you lose money, then you make it up later. I think that if you're somebody who day trades or somebody who loves investing and is trying to time the entry points, I think that I think there's tremendous opportunity, because I think that there's so much nuance in the data. But for somebody who says, listen, I do the right thing, I put my money in my 401k plan, and I'm going to retire in 15 years from now, I think you stay in this, and you just have to stay religious that when things sell off, not to react at the wrong time. But really, the comments are for somebody who's looking to trade. My clients are primarily hedge funds, big professional investors, right, and they have to make more tactical near-term decisions.
Suisse Securities Chief U.S. Equity Strategist and Head of Quantitative Research, Jonathan Golub, thanks so much for taking the time here with us this morning. Appreciate it.